Becoming a homeowner is often referred to as the American dream. However, most people don't have a few $100,000 lying around to buy a house in cash. So how do they become homeowners? Well, for most people, a mortgage is what makes homeownership possible. You've probably heard the term mortgage at least a few times in your life. But what exactly is a mortgage? In this video, we'll define what a mortgage is and how one works. If you're just looking for the basics and want to plant a seed for your future home ownership, this video will work for that. But if you're very close to buying a home and need a refresher on some basic to intermediate concepts, this video will help with that as well. So, what is a mortgage? The simple definition is that it's a loan used to buy a home. However, the truth is that there are many more layers to it. So, a more detailed way to describe a mortgage would be that it's a loan used for the purpose of real estate. Therefore, a mortgage is only available for individuals that are looking to purchase or already own real estate. Common reasons for a mortgage include, number 1, buying a house or any property between 1 to 4 units. Number 2, refinancing an existing mortgage loan. Number 3, taking equity out of your home. Or number 4, buying land. During this video, when we use the terms home loan or mortgage, we'll mostly be speaking about the act of buying a new house. As we go through this video, we'll start off by defining some key mortgage terms and then branch off from there to some more complex topics. If you find value in our videos, we would greatly appreciate a click on that subscribe button, and we would love for you to be a part of our Hero Banker community. Okay, now let's get started. In a mortgage loan transaction, there's usually 3 parties involved. The first party is the lender. The lender is the entity that will be providing the loan. This is usually a bank, credit union, mortgage company, etc. The second party involved is the borrower. The borrower is the person or people who will be receiving the money in the form of a home loan. These funds can only be used to buy the home and nothing else. The third party involved is escrow. Escrow is an independent third party that has no ties to either the lender or the borrower. The purpose of escrow is to ensure that the loan transaction goes through smoothly and correctly. After all, anyone who's ever bought a home knows that it requires various steps, several signatures, and a lot of paperwork. Escrow basically ensures that all the I's are dotted and T's are crossed. Another term that you may hear is title. Title is similar to escrow, although they serve different purposes, but it's also an independent third party that helps to facilitate the transaction. Okay, now let's talk about the loan. Remember, the lender is going to provide money upfront to the borrower. The borrower will then use this loan to purchase a home. So, let's say that Robert wants to buy a house for $100,000. But Robert only has $50,000 and needs a loan for the other $50,000. In this case, Robert is the borrower and ABC Bank is the lender. Escrow and title will help to facilitate the loan transaction. So in this example, ABC Bank is providing Robert with a $50,000 home loan. Of course, ABC Bank isn't doing this out of the kindness of their hearts. ABC Bank will be charging Robert interest on this $50,000 loan. So, let's talk about some of the key terms having to do with the loan itself. The first term, which we just touched on, is the interest rate. This is the total percentage that ABC Bank will be charging Robert for the loan. In this case, we'll say that ABC Bank is charging an interest rate of 5% for the loan. The next key term is the loan amount. Loan amount is pretty simple, as it's the dollar amount of the loan being made. In the above example, the loan amount is $50,000. The loan term defines the length of the loan. This usually means how long it will take before the loan is paid back. Common loan terms include 30 years and 15 years. Another important term is the monthly payment. This is typically the amount that the borrower will be paying to the lender every month until the loan is paid off. In the example above, with a $50,000 loan amount with a 30-year term and a 5% interest rate, the monthly payment comes out to about $268 per month. One other thing to be aware of is any fees associated with the mortgage loan. different lenders charge different amounts of fees. So when shopping around for the best rate, it's also important to take fees into account. This can easily be done by comparing the APR. We won't get into this today, as that would require a video of its own, but we will do a video on APR and how it works soon. One final component of a mortgage is that the property will be used as collateral. This means that the borrower must agree that the lender can seize the property if the borrower ever stopped making payments on the loan. This is done by placing something called a mortgage lien on the property. This mortgage lien gives the lender a legal claim to the property. Basically, while the borrower is making payments, both the borrower and the lender own the home together. Once the loan is paid in full, then the borrower fully owns the home on their own. If giving your lender a claim to your home sounds odd, just think about it like this. What if you let someone borrow $500,000 to buy a home? Would you want some recourse in case they stopped making the monthly payments? Probably, right? Okay, so hopefully the basics of a mortgage make sense. Before we move on, let's do one more example in order to make sure that we've grasped all the concepts. Jane wants to buy a house that is selling for $500,000. Jane currently has $100,000 in her savings account to use for the down payment. So in order to buy this house, she will need a $400,000 home loan. Jane calls ABC Bank and finds out they're offering mortgage loans with a 6% interest rate and a 30-year term. Jane applies and is approved for a $400,000 loan amount. Once again, the loan will have an interest rate of 6% and a term of 30 years. This means that Jane is looking at a monthly payment amount of $2,398. Okay, now let's dig a bit deeper into the monthly payment. The monthly payment is a combination of principal and interest. The principal portion is the amount of Jane's payment that pays down her outstanding loan balance. In this case, that amount is $400,000. The interest portion of the payment covers the interest rate that is charged by the bank. In this case, that's 6% of the total loan amount. One quick mortgage tip regarding monthly payments, principal, and interest. Some borrowers are looking to pay off their mortgage loan as quick as possible. One way to do this is by applying extra payments to only the principal balance. So, in Jane's case, she would make her monthly payment of $2,398. If she wants to pay off the loan quicker than the 30-year term, she can choose to pay an additional $500 towards the principal every month. Or she can choose to do this whenever she has extra money, such as a tax return. One of the main benefits of doing this is that the borrower will pay less interest over the life of the loan. All right, so those are the basics of a mortgage loan and a monthly payment. This should give us a base understanding of how a mortgage works before we move on to more complex topics. As always, if there's any questions, let us know in the comments below. Now we're going to move on to different loan types and loan programs. When it comes to choosing the home loan that is best for you, it's important to have an understanding of the different types of mortgages available. But before we do that, we're going to end this video and we'll pick up where we left off on our next video. That next video will discuss loan types, loan programs, and the pros and cons of an adjustable rate mortgage. If there's anything you'd like to see in that video, let us know in the comments below. So, do you feel like you have a better understanding of how a mortgage works? Did this video help clarify what a mortgage is and how it works? If so, let us know in the comments below. If not, we'd love to hear what we missed or what we should add to our next video. We always welcome and appreciate the feedback. Until next time, thank you for watching.